Hello, fellow investors. Today we are at Finnish Nordnet studio. I'm Tuomas, hello, and here I have Tobias Nilsson from JP Morgan Asset Management. Could you tell us a bit about yourself and why are you here today?
Hi, Thomas. Great to see you. Thanks for having me. At JP Morgan Asset Management, I'm responsible for our Nordic ETF business. I've worked with ETFs for quite some time. Primarily, that's entailed working with professional investors and institutions. I think that's why it's so exciting to see ETFs, which have primarily been an institutional investment at the institutional fees, also become available for Nordic savers via Nordnet. And today we're going to discuss REI, which is a new field of ETF investing.
So what are those? How do they differ from regular ETFs?
So in the near term, REI behaves like a passive ETF. We say that it has a low tracking error to the benchmark. The biggest drivers of your risk and your reward comes from sector allocations and country allocations. And the REI suite is no different in that regard, in that they have the same weights as the benchmark to countries and sectors. The difference really lies in if you were to visualize a passive ETF tracking its benchmark, you would find that they are pretty much the same. Simply put, a ETF will underperform the benchmark on an annual basis to the extent of their management fee, or TER. The REI also follows that benchmark in the near term. The goal is not to track it perfectly, but to, in small increments over time, add performance via security selection. So the difference here is then not to track the benchmark, but to outperform it to the magnitude of 0.50% to 1.25% annually, or around 0.75%. And that should be done at a similar risk to the passive investment. And they also have the same characteristics that we appreciate with ETFs, and that they are low cost, liquid, and transparent.
Okay, but traditionally ETFs are considered as like low fee passive investments, and now you're saying that there is an active component to them in these REIs. Do you have any proof that this whole thing makes any sense?
Well, the proof that it's worked in the past is the track record. JP Morgan Asset Management have been managing these strategies for over 30 years in other vehicles. That's one of the most important things to consider when you're evaluating an active component, being the track record and the consistency of that track record. The second important element is understanding what the investment process looks like. In the case of REI, there's not a one-star portfolio manager, but rather a team of 150 sector analysts that specialize in their market and in their sector to form a view on the future stock price of a company. The analysts that they've been doing this for a long time, on average 10 years, and they evaluate companies both on fundamentals, but also meeting with management of the stocks and understanding their strategy. Over time, they've demonstrated to be able to pick the stocks in a sector that performs well, and that is really the active component of REI, small over or underweights at stock level. The portfolio manager is still important in picking the best ideas of the analyst and also manage risks to the benchmark. So REI is not about which sectors or countries you're exposed to, in a sense that is passive, but it is which companies in a sector you're exposed to, and that's the active component. And so the REI suite wants to combine the best of passive. Again, the biggest drivers of your risk reward is within country and sector allocations, but also the best of active in a demonstrated and a more consistent way to add performance via security selection.
All right, so ESG and sustainability are like big themes nowadays and in great demand in investing as well. So how do you incorporate sustainability in your stock research?
Great question. REI excludes outright weapons, tobacco, and coal, much like a ESG screen passive ETF would. The difference lies in, as much as the analysts form a view on the future stock price of a company within a given sector, they also do so from an ESG perspective. That enables us not to invest in a company that performs poorly or favor one that does. And that's an important difference. Engagement is another element where meeting with management, we want to drive positive change. And this is a very important topic, and our clients are looking to us to also communicate that at the end of the year in reports.
What sort of role should these REIs play in investors' portfolio? Should these be like the core of the portfolio, or just a little spice at the edges?
So REI are core building blocks. They provide passive-like risk and return. Professional investors use them much the same way as they would a passive ETF, but particularly over longer time periods. If you're unsure how REI could perform alongside a passive ETF, you could always try a little spicing around the edges, but the most important thing is to give it enough time so you can properly evaluate it.
All right, so do you have any tips in the end of this video for the new ETF investors?
Well, my expertise is with fund selection and ETFs, so I don't want to give your investors too much asset allocation advice. There are much better people at JP Morgan to do that, but I would say think about a balanced portfolio and diversification. ETFs provide in one security diversification to many stocks. Also think about your global equity portfolio. Consider developed markets versus emerging markets. If you're unsure, you can always act passively in that regard, or trusting the market and how it's pricing in these regions. In that case, you would have around 88% developed markets and 12% emerging markets. Depending on your risk-reward profile, however, you can choose to either overweight or underweight emerging markets. Similarly, for your developed markets portfolio, you can consider the US versus Europe. REI is available in developed markets, which is called Global REI, US, Europe, and emerging markets. And we're also launching new exposures towards the end of the year. Another factor which is often overlooked is time diversification and having the discipline to invest over a time cycle. The stock market goes up and down, and it can be difficult to time the markets. So it's actually proven a good strategy over time. Lastly, I would say 2021 has been a strong year for equities, in particular developed markets. If we are entering still a positive but lower rates environment for 2022, that additional income over passive will be even more important.
Thank you, Tobias, for the interesting interview.
Thanks so much, Thomas, for having me and for the great questions.
This was fun. And thank you for the viewers out there. If you want to learn more about these JP Morgan REI ETFs, you should check out our landing page. We will link it down below.